Hi everyone. Today I wanted to discuss audit procedure and audit approach, which includes 5 steps: pre-planning, planning, execution, completion, and reporting. And I want to talk about each one of them. Let's start with pre-planning. It is a very important stage. Because you might think that if there is a request from a company to make the audit and it will pay you money, you will accept. You just will accept the request. But actually, auditors do not accept all the requests, even if it has all the resources, time, members, competence, even if it can physically accept all the requests, it will not accept all the requests. And we are going to talk about why. So first of all, we need to check, do we have available audit team members? We need to know about clients' expectations about the deadline of the issuing of audit opinion. We need to check the reputation of the client, and it should match the reputation of the auditing firm. For example, big four firms, they will not work for a company that had a lot of scandals. If there is a case that this company cannot be trusted and this company had bad situations that happened to that company, and actually this client company was to blame in this situation, then KPMG and PwC and other big firms, they will actually reject, because it has a reputation of trustworthy and just professional international company that does not is not engaged in this frauds, scandals, lawsuits. No, we don't need that. Actually, if a client was was working with other, for example, big four firms, we need to find out what was the reason of them switching up to our company, because it's suspicious. Switching the audit firms takes a lot of time, a lot of documentation work, and it's like a headache, and who wants an extra headache? And if you want to change, if you were not happy and satisfied with your previous auditing firm, then why? Because big four companies have the same methodology and the same logic behind their audits. So it's kind of suspicious, because is there something that we need to know? Is there something that you want to hide from us? And there are several ways that it can go. For example, the client can say that, no, actually, no, we do not want to disclose any information, and you cannot go to our previous auditor to kind of see their methodologies, to see the documents. We actually do not allow you to do that. And if they do not allow, then auditing company can absolutely, for sure, reject that company, because it's very suspicious. And also, if they go to, for example, we are keeping G and we go to PricewaterhouseCoopers and ask for the disclosure of the documents and they say no, it's okay. It's okay. But then in like 4 years, when you will come eventually to us, because there are only four big auditing firms in Kazakhstan, we will remember that, and we also will not disclose any information. So it's like, like auditing firms should not have any um any conflict. And you know why? Because it's like there are so few of them and they kind of always switch the clients, and like the clients go to that to PwC, then to EY, then to KPMG, then to it's like they always kind of change the clients, and it's like there's no reason for PwC to be like to kind of have KPMG as an enemy, because the field is too narrow and the industry is small. Like, we can call it small because there are, for example, 4 auditing firms, so it's like not very much. Okay, so we need to decide, are we competent enough to actually do the audit of the company? Because there was a case when for example, KPMG had to audit a space firm that was like sending rockets to space, and one rocket actually got lost in space, and there was a conflict between auditing and client, and the auditors, because they're so skeptic and because they're so risk averse, they say that we definitely need to make impairment position. Okay, so we definitely need to say that we lost actually this spaceship, because auditors, they are very, like, they are more pessimistic than optimistic. You know why? For example, it definitely recognizes all the, for example, bad debt expense, all the risks, but it definitely does not recognize revenues as soon as it had the revenue. No, they need to provide a service, they need to like do all these conditions, and it's like professional skepticism. So they were like, we need to say that this ship is like lost and the assets go down and so on, and the firm says no, we actually are finding it right now in the space, and they were like optimistic about it. So they had to call the international office in like United States of America that actually were competent enough to solve this problem, and they solved this problem and everything was okay. But like, it's just saying that we need to be sure about the amount of knowledge that we acquire and that we can actually provide professional service for the company. And then there can be a conflict of interest. For example, when PwC will audit McDonald's and Burger King in the same time, in the same period of time, and actually, like, Burger King will not be so happy about it, because actually some auditor may kind of talk about this case and talk about some monetary information that they don't want they don't want it to be talked about, and they were like afraid that McDonald's will kind of like somehow hear about it. But like, an auditor should not ask for permission of neither McDonald's nor Burger King to kind of accept the client, but it definitely like should say, I hope it's okay for you, because it's not, I don't think it's such a big deal. But maybe it's because I'm not a business owner or something. Okay, let's talk about the planning stage. In the planning stage, we should challenge all information. Don't believe information without evidence. For example, when we apply going concern assumption, and the company is literally going bankrupt, and it concerns 12 months after the reporting period, which is the 31st of December in Kazakhstan. So after that reporting period, after that, the company will try to sell all the liquidate the company and sell all the assets with market price. And this situation requires different methodology, different standards. Just it has different rules of calculating the numbers. So in this stage, we need to be like, we need to plan like what methodology we're gonna use, what strategy we're gonna use. Like we actually need to be prepared for the actual audit. So if in pre-planning we decide, do we accept and sign the contract, or do we not accept and reject the client? In planning, we actually like sign the contract, and we can go to, for example, the previous auditor and check everything, because if they did mistakes in the previous year, the numbers of this year are going to be wrong, and it creates a lot of problems and a lot of time, and much time will be just wasted because we did not check the previous financial statements. Okay, now after that we have execution, like the actual audit. We're checking all the financial statements. Then we have completion. We decide what to include in our audit opinion. We kind of collect all the evidence. And in reporting stage, we issue our audit opinion. So what can we say about audit risk? Audit risk concern drafted balance sheet and income statements, because if in 2 years, 2 consequent years, you see an unusual decrease on or increase in revenue, it is very suspicious. Well, maybe they increased the selling price and the revenues went up by 30%, or they increased the cost of goods sold and the revenues went up. But if it did not happen and the revenues increased, that's the point when auditors should be like the most attentive. Revenue is like a very high risk account, because a lot of companies companies will try to make more revenues because it will be more attractive to the investors. And it can be subject to manipulations. For example, revenue will be recognized earlier, and they will be playing with figures and estimates. So revenue shows like the financial performance of the company, and it's like something that is like the main показатель. The main thing that investors look at. And there can be the problem with auditors of components, which is subsidiaries of uh, consolidated financial statement. For example, what is consolidated financial statement? It's like I have office, I have business in UK, USA, Australia, Kazakhstan, and Russia. And consolidated financial statement is the financial statement of all these companies in like one big financial statement. And what is the main difficulty in this situation? For example, in London, there's UK GAAP, and in order to make it consolidated, it needs to be transferred also into IFRS and US GAAP. Then transferred to Australia, and then they have IFRS, and they have to like translate it into US and UK GAAP. It's like translating this financial statements from one international standard to another is like a lot of work, but this extra work is actually paid. Extra work hours are paid, extra money, and usually workers from other companies understand that, and they do not reject this task of like converting from one to another. Actually, one of the most popular themes is like IFRS and GAAP problems of convergence, or like IFRS and GAAP in Kazakhstan. Which is like more popular? For example, in Kazakhstan we use IFRS, but we in our university we actually study US GAAP. Why? Because we work by the standards, by in the international standards, and but we also have a course called IFRS, which I'm not taking, and I'm happy about it. Okay. Oh, okay. So there's also the problem with scope of audit, of inventory. Okay. So example, there's a company named Nestle, and it had only one warehouse in Almaty, but Sulpak is a company that is actually exists in every country. The warehouses of Sulpak exist in every country of Kazakhstan, and this creates a problem for Sulpak auditors to they need to send their auditors to like the main warehouses of this country, of this cities, and it is time consuming. And what is an interim audit? For example, interim audit can be done for income statements for the first 9 months of the year, because in the income statement for the first 9 months we still have revenue, we still have our revenue, and we still have our expenses, and after that, these 3 left months, October, November, December, we can just add those numbers to the previous numbers. So it's like to make it easier for us to calculate all these numbers afterwards. So I hope I explained everything more or less understandable, and thank you for watching.